Welcome to Iron Financial. This is the only place where we forge stronger portfolios by stress testing market narratives and, well, cutting straight through the weakness. I'm your lead analyst, and with me, as always, is our market skeptic. His job? To ask the tough questions you're thinking and to make absolutely sure that any hype is backed by a foundation of solid iron. So today, we are putting a falling titan under the microscope, SolarEdge, ticker SEDG. Now, this is a company that has been to the absolute brink, the very edge of the abyss, and is now trying to claw its way back with a set of numbers that, frankly, demand our attention. But that's the whole ballgame, isn't it? Is this a genuine recovery built to last, or is it just another rusty, tempting value trap waiting to spring on the next wave of unsuspecting investors? Let's dive in and see if this thing is structurally sound or if it's about to crumble.
Okay, before we even start talking about some kind of comeback, we have to acknowledge the sheer carnage here. Just look at this chart. This is the starting point for our entire analysis today. You have to understand the hole they're in, and carnage is exactly the right word. This isn't just a correction or a little dip. This is a complete and total collapse. We're talking about a Wall Street darling trading way up over $300 a share, brought down to absolute rubble. This represents a catastrophic multi-billion-dollar destruction of shareholder value. This right here, this is the crater that SolarEdge is trying to climb out of. And you better believe the market has a very, very long memory for this kind of pain.
And that really is the multi-billion-dollar question that's on the table today, isn't it? We've seen this flurry of positive headlines lately, some truly eye-popping numbers in their latest 2025 reports. But is this a real turnaround? Is this real strength? Look, have they actually repaired the deep structural damage that caused this collapse in the first place? That's the key. Or is this just a classic dead cat bounce, that little blip up before the next devastating leg down? That's what we are here to determine. We're not just going to look at the numbers. We're going to put the entire foundation of this company under a serious stress test.
To really get what's happening with SolarEdge right now, you have to see it as a story of two opposing forces, just locked in this brutal tug of war. On one side of the rope, you have the memory of that catastrophic collapse we just looked at. All the fear, all the doubt, all the investor distrust that comes with it. And on the other side, pulling with every ounce of strength it's got, you have what appears to be one of the most stunningly rapid financial turnarounds we've seen in this whole sector, with all the key action happening in fiscal year 2025. It's the past versus the present, and our job is to figure out which one of these forces is stronger.
And that reversal is exactly where the bull case begins. It's not just a vibe shift or a change in sentiment. We're talking about a quantifiable, measurable change in the company's core financial health. Okay, I'll give them this. The numbers they just posted are, on the surface, impressive. A reversal of fortune is one way to put it, for sure. But my job here is to look past those headline figures. We have seen plenty of companies pull a rabbit out of a hat for a quarter or two, right? The real question is about sustainability. Is the core business actually healthy, or did they just slap a fresh coat of paint over a crumbling, rotten structure? That's what I want to know.
All right, let's just put the skepticism on hold for a minute, because it is time to lay down the hard data. The bull case for SolarEdge, it isn't built on hope or hype. No, it is being meticulously constructed on a foundation of cold, hard numbers that show a company systematically pulling itself back from the abyss. So let's stop fixating on the crater for a second and start examining the bedrock of this turnaround they've apparently engineered. The very first pillar of this new foundation is top-line growth. For the full year 2025, SolarEdge grew revenues by a staggering 31%. Just let that sink in for a moment. This isn't a company treading water. This is aggressive expansion. They went from about $901 million in 2024 all the way up to $1.18 billion in 2025. Whoa. Okay, 31% is a big number. I'll grant you that. But in a really tough solar market, where did that growth actually come from? Are they gaining real, sticky market share, or were they just clearing out a bunch of old inventory at a discount just to juice the numbers? A big revenue number doesn't mean a whole lot if the quality of those sales is poor.
And you know what? That's a fair question. And I think this slide right here provides the answer. What's really interesting here is that it shows where the heavy lifting happened. Look, revenue is vanity, profit is sanity. But cash is king. And in 2024, SolarEdge was hemorrhaging cash. A 5-alarm fire burning through over $421 million. But then look at 2025. They completely reversed that flow, generating nearly $77 million in positive free cash flow. That is a $500 million swing. A $500 million swing is massive. But again, how? How did they do it? Did they achieve this by actually becoming more efficient, or was it by starving the business of critical R&D and capital expenditures, or maybe by stretching out payments to their suppliers? Generating cash is great, But if it comes at the expense of future growth, it's what we call a Pyrrhic victory.
And this wasn't an accident. This wasn't some one-time accounting trick. This comes directly from the top. The CEO, Shuki Nir, laid out the game plan himself. This was a deliberate, focused strategy. The keywords here are restore discipline. They weren't just chasing growth at any cost, which, let's be honest, is what got them into trouble in the first place. No, they went back to basics, focusing on the fundamentals, cash flow and margins. Talk is cheap. Every single CEO says they're focused on discipline after their stock gets vaporized. This quote tells us that management knows what they're supposed to say, but we need to see if the actual numbers back up this claim of rebuilt margins and true discipline.
And this brilliantly illustrates that they did just that. I mean, if you look at nothing else, look at this table. This is the architecture of the comeback. It's the blueprint of the entire repair job. The GAAP gross margin went from a disastrous negative 97% to a positive 16.6%. That's not just an improvement, that's a resurrection. Okay, a resurrection into positive territory is good, but let's be crystal clear. A 16.6% gross margin is not exactly setting the world on fire. It's stable, sure, but it's not a high-margin business at this point. And now look at the operating loss. Yes, they cut it by over 80%, from a staggering $1.7 billion down to $301 million. But it's still a $300 million loss. The foundation might be repaired, but the house is still losing a lot of money every single year. This is not a profitable enterprise yet, not by a long shot.
A foundational repair job? Or maybe just some hastily poured concrete over a giant sinkhole? That table looks better, I won't deny it. But a building with a repaired foundation can still have deep, load-bearing cracks in the walls. And frankly, I see them everywhere I look. Now it's time to take out the magnifying glass and examine the parts of this story they don't exactly put in the headline of the press release. Let's start looking for the cracks in this new armor.
And the first, most glaring crack comes from their own legal filings. This is not my opinion, this is a direct quote from their 10-K report filed with the SEC. They're telling us in black and white that their own customers are in trouble. They've had to extend payment terms and even provide direct loans to keep their distributors and installers afloat. Now, that's a known industry-wide issue. High interest rates have squeezed the entire residential solar installation ecosystem. SolarEdge is just being transparent about a risk that every player in this space is facing right now. But the crucial point is this: how strong can your recovery truly be if the very people who buy your products are on financial life support? That's a massive, flashing red flag right at the heart of their business model.
And it gets worse. Let's build what I like to call the wall of worry, starting with the industry itself. The company admits the solar industry is rapidly evolving and competitive. It's historically cyclical, which is a nice way of saying it goes through absolutely brutal downturns. Alternative technologies are a constant threat. Their customer base is consolidating, which gives those buyers more pricing power against them. Every growth industry is competitive. That's not a unique risk to SolarEdge. They've proven they can compete. But the entire business model for their customers is subject to the whims of government policy, like sudden changes to net metering rules. They aren't rebuilding on solid ground here, they're rebuilding on shifting sands. One legislative change can wipe out demand overnight.
Okay, now let's move to the next layer of this wall of worry, their own operations. This isn't a company that fully controls its own destiny. They are heavily dependent on a small number of contract manufacturers in Asia and, in some cases, single-source suppliers for critical components. Well, that's the modern global manufacturing model. It allows for capital efficiency and scale. It's also a massive point of failure. Any disruption, a factory fire, a shipping delay, a sudden price hike from one of these suppliers, can bring their entire operation to a grinding halt. Their supply chain is a tightrope, and there is no safety net.
And finally, let's look at the powerful forces that are completely outside of their control. Inflation and rising interest rates make solar projects more expensive for the end customer, which kills demand. The Inflation Reduction Act, or IRA, which has been a huge tailwind for this industry, is subject to the winds of political change. But the IRA has broad support, and it's driving significant onshoring of manufacturing, which will benefit them in the long term. Maybe. But the company's own 10-K notes that a new administration has already paused some of the grants. That's a fact. Add in global unrest, tax law changes, and the inherent volatility of their stock, and you have a company that's exposed to massive risks that management can do absolutely nothing about. This isn't just a wall of worry, it's a fortress of risk.
And after all that, after all the talk of a turnaround and restored discipline, let's just land on the final, undeniable number. This is their GAAP net loss for 2025. They still lost over $405 million. Now again, that's a massive improvement from a $1.7 billion loss the year before. The trajectory is what matters here. But the bottom line is still deep, deep in the red. A company that loses this much money is not a healthy company. Period.
The turnaround story is incomplete at best. The patient might be stable, but they are still bleeding out, just a lot more slowly now.
A loss, yes, but a dramatically smaller loss. You cannot ignore the trajectory. Look, management isn't just sitting back and admiring their repair job. They are explicitly shifting from playing defense to playing offense. They believe the foundation is now strong enough to not just support the old business, but to build something new and far more ambitious on top of it. This whole section is about where they are going, not just fixing where they've been.
The CEO is talking about going on offense, scaling their new Nexis smart energy platform, and aggressively capturing market share. This is the vision they're selling. Yeah, a shift to offense sounds great in a press release, but let's apply a little reality check here. Scaling a new platform carries huge execution risk. Capturing market share means jumping into a price war in a brutally competitive landscape. And the most interesting one to me, this pivot to AI data centers. It sounds exciting, sure, but their own commentary says they don't expect any meaningful revenue from it before 2027. That is a long, expensive road with absolutely zero guarantee of a payoff.
And I really want everyone watching this to understand this critical concept. When a CEO talks about their grand plans for 2026 and beyond, it's so essential to know what a forward-looking statement is. This definition is pulled right from their SEC filings. It's just a standard legal disclaimer. Oh, it's much more than that. Its lawyers speak for it. This is our best guess, but please, for the love of God, do not sue us if we're completely wrong. It's a formal admission that these plans are subject to every single risk we just discussed on that wall of worry. The company's grand vision for the future is an aspiration, folks. It is not a guarantee. Remember that.
But you have to give them credit for at least looking beyond their core business. The AI data center opportunity is undeniably massive. This could be a stroke of genius, leveraging their deep expertise in power electronics to tap into one of the biggest secular growth stories of our decade. Or it could be a massively expensive, high-risk distraction that pulls focus, talent, and capital away from fixing their core solar business, which, as we've already established, is still losing hundreds of millions of dollars and faces enormous headwinds.
And that brings us to the final verdict. We've laid out the bull case, and it's built on a powerful and, frankly, undeniable financial reversal. And we've laid out the bear case, which is absolutely riddled with external threats, operational risks, and just nagging questions about sustainability. So it's time to put it all on the scales. Is the core of this company now forged from solid iron, or is this comeback just a thin plating that's going to quickly give way to rust?
Okay, let's summarize the bull case. These are the pillars of strength. This is the iron. You have undeniable 31% revenue growth in a tough market. You have a nearly $500 million swing to positive free cash flow, which is the absolute lifeblood of any industrial company. You've got gross margins pulled from a near total collapse back to respectable positive territory. Their own earnings call highlighted that they are actively gaining market share in the US and stabilizing in Europe. And you have a CEO with a clear, aggressive plan to go on offense. This is the argument for a company that has been rebuilt and is maybe even stronger than before.
But then you have the rust, the weaknesses that threaten to corrode this entire structure. You just cannot ignore the history of that stock collapse. It reveals how quickly things can go wrong here. We built that wall of worry using their own documented risk factors. It is an overwhelming and frankly terrifying list. The bottom line is that they are still losing hundreds of millions of dollars. The company itself has warned us that its own customers are in financial distress, and their entire future growth story depends on them successfully executing brand new, unproven strategies like this big AI pivot. This is the argument that the company is still fundamentally fragile and brittle.
So the crucial point is this. SolarEdge has successfully performed emergency surgery. They have stopped the corporate collapse and they've stabilized the patient. The financial bleeding has been contained. But the question that every single investor must now answer for themselves is whether this new foundation is truly solid iron, strong enough to support future growth and withstand the inevitable market storms, or if it's just a temporary patch, already showing the first signs of deep rust. The heavy lifting of the turnaround has been done, but as an investor, you have to decide if the hardest work, and maybe the greatest risk, is still ahead.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.